Gary Bedford, partnered with Cambridge Investment Research, is a concierge financial management firm located in Boulder County, Colorado since 1982. Gary produces a market and economic brief quarterly. Market performance is tracked using a unique under-the-numbers approach. We study 5 macro drivers: capital, demographics, technology, global markets, and ecology. Here is Gary's market and economic brief.
So welcome to beautiful Boulder, Colorado, Boulder Valley, Indian Peaks Wilderness, Longs Peak, for our first quarter 2020 market update. Good day, I'm Gary Bedford and happy to be with you for our first quarter 2020 markets and economic commentary. The first quarter of 2020 continued 2019's positive momentum as U.S. stock markets reached new peaks. Markets, however, were then kicked hard, first by the Covid-19 ecology crisis and then an energy oil global market crisis. Stocks and real estate investment trusts were down 20 to 30%, and the global economy shuddered. But surprise, a major cable news anchor hyperbolically and inaccurately reported it was, quote, the worst quarter ever for stocks, when in fact, it was really the greatest point drop ever. In fact, it was the worst quarter since the financial crisis in 2008 and 9. Yet the 2020 correction is not unusual. This chart shows corrections by decade since 1900. 2000 to 2010, for example, had a 54% correction to the negative in the dot-com collapse in 2000, 2001, and 2, and a 38% drop during the financial recession in 2008 and 9. Those are calendar year corrections. What's not normal is the 2010 to 2020 period with no market corrections. So since 1900, stock markets average 2 negative 30% corrections every decade. Still, in my 40 years of observing markets, it's difficult to recall another market reversal like this. From all-time market highs, the lowest unemployment in memory, robust gross domestic product growth, and then a world pandemic, social distancing, businesses slowed or closed completely, and an oil price war between Saudi Arabia, Russia, and the US. So let's look at COVID-19 with a longer historical perspective. The Standard & Poor's 500 US large company chart above tracks global health crises from 1981 to 2019, including HIV/AIDS, SARS, H1N1, MERS, Ebola, and the measles 2014 and 2019. In all of these, markets declined sharply, but then recovered within 12 months or so. And none of these events led to economic recessions. Our summary, so 2020 will be punctuated by coronavirus and economic disruption, including energy volatility. Here's how we look under the numbers with our unique market, capital market and economic methodology. Ecology. The COVID-19 virus hits, just like HIV/AIDS, Ebola, and these were far more deadly. It will then, the ecology macro will affect the other 4 dramatically. Technology. Technology contributes in the form of modern air travel, which spreads the virus instantaneously, but then tech begins to adjust with emergency hospital capacity development, quick tests, antivirals, vaccines. The demographic or human macro. Well, we see social distancing, layoffs, loss of life, and survival. Governments, though, respond, cooperate to some degree, and we move forward. Global markets, The global markets are disrupted. Oil demand and prices decline sharply. Saudi, Russia, US get into a production price dispute. And finally, the capital macro. The Federal Reserve steps in with massive lending, payroll support, and this new debt is perhaps the most worrisome long-term effect of the crisis. So the crisis exposes cracks and vulnerabilities that were there in the first place. Markets will rebound, but we have seen a big chunk of economic activity lost for 2020. People will adjust. Hopefully, medical preparedness will advance. Global governments will work more closely going forward. Vital supply chains may be restructured, and energy markets will restabilize under new efficiencies. But the macros will continue to lurk and be unpredictable, and so therefore threaten but also dynamically boost economies. How to prepare? First, we believe we try to structure and prepare portfolios in advance of volatility. Secondly, we try to hedge risk assets. Index annuity and hedging instruments, which we use, can complement standard risk approaches. Third, we want to control the buy-sell triggers by owning stock and risk assets directly. We avoid equity mutual funds, for example. We use fractional share technology to optimize diversification and control buy-sell activity. Fourth, we use tax-efficient techniques to reduce tax drain. And lastly, as much as possible, we encourage you and our clients to optimize your own health, exercise, moderate nutrition, work with medical advisors. So 2020 is off to a roller coaster start. Hold on the street, the word is don't panic, don't talk to strangers, don't touch your face, and don't touch your portfolio. And as always, give us a call. You can read informative articles on our website, GaryBedford.com, all of which will become available soon in video format. Our firm is moving proactively into the 2020 crisis. We made a $1,000 donation to the American Red Cross. We're giving blood, and we're here for your calls, and also pro bono for family members and friends as they seek financial counsel. So thank you for now. Stay safe, and we'll talk to you at the end of the second quarter.